What if I told you there's a single chart that has successfully predicted every recession for decades? And now, it's flashing red again. Are we heading for another economic storm? Let's break it down because this could change everything. Hi everyone, welcome back to the channel. Today, we're diving into a powerful tool that many economists, analysts, and even investors rely on to predict recessions. The yield curve. Sounds complicated. Don't worry, I'll simplify it for you and explain why this chart is making headlines again. Stick with me to the end, and you'll understand what's happening and what it could mean for your money. The chart we're talking about is the yield curve inversion. Now, before your eyes glaze over, here's what it means in simple terms. Imagine you're lending money to someone. If they borrow for a short time, you expect a small interest rate. But if they borrow for a long time, you'd expect a higher rate because you're taking on more risk. Normally, the interest rate for long-term loans is higher than for short-term loans. But when a yield curve inverts, the opposite happens. Short-term rates become higher than long-term rates. This unusual flip has historically been a warning sign of a recession. And guess what? It's happening again right now. Here's why this matters. Every recession in the US since the 1950s has been preceded by a yield curve inversion. That's over 70 years of accuracy. For example, it inverted in 2000 right before the dot-com crash. It flipped again in 2006, just before the 2008 financial crisis. Fast forward to today, and the yield curve inverted months ago, and it's been staying that way. Economists and financial experts are taking this very seriously. Let's quickly explain why a yield curve inversion is such a reliable signal. When investors think a recession is coming, they pile their money into safe, long-term investments like government bonds. This drives long-term interest rates lower. At the same time, central banks often raise short-term rates to fight inflation, causing short-term rates to spike. This push and pull creates the inverted curve, a sign that people are losing confidence in the economy's short-term prospects. Here's the kicker. While the yield curve has predicted recessions with incredible accuracy, it doesn't predict when they'll happen. Sometimes, it takes months, even over a year, for a recession to materialize. And while history gives us a strong clue, other factors like government policy or global events can influence the outcome. But with high inflation, rising interest rates, and global uncertainty, foundation. The yield curve is a powerful warning signal, and ignoring it could be costly. So, what do you think? Is another recession on the way? Drop your thoughts in the comments below, and let's start a conversation. Don't forget to like, subscribe, and hit the bell icon for more videos like this one. Stay informed, stay prepared, and I'll see you in the next one. This chart predicts every recession. It's happening again, the shocking recession warning signal everyone's ignoring. Yield curve inversion, the economic red flag you need to know about. Recession alert. This chart has predicted every crash. Why economists are sounding the alarm again. Recession warning. How this chart predicts economic collapse, and it's flashing now. Let me know if you'd like to tweak or expand on anything. 40